Financial Accounting Inventories, Part 3 of 3, Chapter 6. Fortunately, Part 3 of 3 is a little less quantifiable and a little bit more theoretical for those of you that like theory, or as we like to call it in academics, concept. So we're just going to mention, and we've said this many times in the prior two videos, that whenever you assume a different method, FIFO, LIFO, weighted average, you're going to get different cost of goods sold, gross profit, net income, ending inventory, total assets. Your retained earnings are going to be different. It's amazing at what the difference will be just by valuing this inventory. Now, look at this second bullet, because this is something we have to realize. If the world were nice and simple, then if costs remained the same, nothing would change. But as we know, look at your gas station around the corner, prices change all the time, which means that. So if you look at an inventory system, this is just for illustration purposes, look at the different gross profits that could happen between FIFO, weighted average, and LIFO. LIFO appears to be the lowest in this case, a lower gross profit, because typically prices are rising, and that means that the last inventory that came in that is used to value cost of goods sold is going to be higher. Typically, you're going to get a higher gross profit because your cost of goods sold are going to be a little bit lower because you're using your older FIFO prices. Weighted average is generally somewhere in the middle. As we look at the effects of changing prices, no, please don't memorize this. It just shows you that, for example, if you use, if you're looking at the fact that prices are going up, then LIFO is going to give you the highest cost of goods sold and the lowest, FIFO is going to give you the lowest. Whereas if prices are going down, then FIFO is going to give you the highest cost of goods sold and LIFO is going to give you the lowest. So this is just some of the theory. Now, why do we care? Because in accounting, as a reminder for all students, what you're studying in this intro financial class is the basic financial accounting transactions that are already done for someone who's an accounting major, who's educated in this area and who's working in this area. This is not really anything that's going to be a part of an accounting major's career, unless you're working as a consultant and you're advising a client, and they're a new client and they're about to calculate their inventory, and they have to choose, and you've got to be able to advise them. Okay, do you think your prices will be going up or down? Would you like to use average, FIFO, LIFO? You're going to have to help your clients with understanding these types of issues. It's also important whenever you're reviewing financial statements, whether you're auditing them or not, and for tax purposes, it's got its own set of rules. So when we compare inventory methods, what we find is weighted average is often a compromise, and that's because we've averaged out the cost fluctuations that will occur. So a lot of companies, in the financial statements, as we've talked about from Chapter 1, cost or historic cost is the basis for valuing our inventories. But there are going to be times when the cost of replacing inventory is below. And GAAP, the individuals that write GAAP, the Financial Accounting Standards Board, has found that it would be unfair for a company to show that they have a large amount of inventory on their financial statements when they can't even sell it for what they paid for it. So let's think of something trendy. I'm sure you've got something in mind that used to cost a whole lot of money and now it's very low price. And so companies bought it, hoping to sell it, hoping to make a lot of money. And now they're finding they can't even sell it for what they paid for it. And that would be quite frustrating if you bought a product to sell for, let's say, $100. You paid $100 hoping to sell it for $175. And you find you can't even sell it for $80. Well, it would be unfair for your financial statements to reflect the cost of $100. So if inventory has imperfections or style changes or damage or obsolescence or another cause, then we've got to use a different method, and that is called LCM or the lower of cost or market method. And the lower of cost or market method is a method used to value inventory where we say, okay, if the market value is less than the cost, we have to take, as it says, the lower. Market value is considered to be net realizable value, and that is how much money can I get out of this after I subtract out any selling expenses. So what can I sell it for, and what's going to be the cost of disposal, and that's the value. So let's take an example of a product that cost $1,000, and the company's not too happy, but it's damaged or it's obsolete, and they find that they can only sell it for $800, and they're going to have to pay $150 just to sell the thing. That's going to be their selling costs. So the market value, or what is known as the net realizable value, is only $650. So on the financial accounting records, there's going to have to be a markdown for the loss. Now that's beyond the scope of this course as far as the journal entry. But lower of cost or market says, sorry, you cannot keep that on your accounting records, and inventory is $1,000. The inventory has to be valued at $650. So let's look at the way this can be done. It can be done for every single item in inventory, one by one, for a class or category of inventory, or it can be taken by the lump sum as a whole to do this valuation of LCM, or lower of cost or market. Here's an example. Let's say that these are the items, the Echo, Foxtrot, Sierra, Tango. And as you notice here, this one costs $10.25, but after subtracting out selling expenses, you can only get $9.50 for it. This one looks like it's doing okay. This one's doing okay, but notice this one has dropped in value. So as we look at what we do, in this one we're using an item by item, we will take the lower of cost or market, and we'll find that even though we paid $15,520 for this product, our market value is only $15,472, and if we use LCM, we're going to price it at $15,070. Now, as far as the balance sheet goes, this is a repeat, and this is our last slide. Inventory on the balance sheet is shown in the assets section, the current assets section, as we said, because it's assumed that we'll be able to sell our inventory within the next year or less. And reports have to show which type of method that you used, and whether you used cost or the lower of cost or market. And when I say the report has to show, there's something that we haven't discussed quite yet, and that's called the footnotes. So if you were to Google Walmart, as we talked about in a prior slide, and you were to do a Google search for Walmart's annual report 2017, you're going to find 4 or 5 pages showing their financial statements. And after that are going to be what's called the footnotes, or the notes to the financial statements. Sometimes it's called the disclosures. And that's where this information is going to be reported. It is required that some type of disclosure is reported showing the method of inventory used by that company. So in conclusion, inventory. Tough cookie sometimes. Companies that have inventory have to make decisions related to the methods they're going to use, whether they have perpetual or periodic calculations, lower of cost or market, FIFO, LIFO, weighted average, or specific ID. And all of these pieces of information are disclosed in the footnotes, and our whole purpose is so that the financial statements reflect the company accurately, so that individuals interested in buying or loaning money to or owning or even being a customer or an employee of the company has full information to be able to make decisions. This concludes Chapter 6. Best wishes with homework. Let me know if I can help any.